Good morning and welcome to your macro outlook. It is Monday, April 7th, 2025. I'm Patrick Ceresna. Let's quickly go through the economic news coming out this week. We have the FOMC meeting minutes coming out on Wednesday. Then we have the inflation numbers coming out on Thursday, the CPI on Thursday, and the PPI on Friday. And while these are all going to be important numbers, what's clear is that these are not going to be market movers per se. There's a lot of technical cross currents going on during this market crash, and these economic data points are, while relevant in the bigger picture, are likely not going to be the focal point of these next major moves. So let's talk specifically about what has been the kind of key driver of this market move. And one thing is clear is that now it's becoming consensus that we're heading towards a U.S. recession. As an example, we were back at the start of March, just going back 40 days ago, we were at like a 20-25% chance of a recession. By the end of March, that was sitting around 40%. And just in the last week, this went skyrocketing to like 68% on the upside. So the market is now, this is using poly markets, was just real money betting. And that just is a very good reflection of where we roughly stand at the recession risk. And so the market is essentially now pricing this in. We witnessed an extraordinary 3-day market crash, basically Thursday, Friday, and going into this morning, that has more or less wiped out 800 S&P points in a very fluid motion. So what now? Should one panic? No. This is the moment to buy. Let me explain. During market events, you always have markets go through these types of crash events. They go and wipe out in this massive way on the downside. And when they capitulate on the short term, they pause and mean revert. Now, just because I think that there's a short-term buying opportunity and a bounce coming, it doesn't change my view that this is a bear market. And in fact, if we go 3 months, 6 months, 9 months forward, it's entirely possible that we could have an S&P trade even down to 4,000 or lower in the many months to come. But this is on the very short term, way too much, too quickly. The analogy I like to offer is like, think of a bungee cord being tied to someone's ankles, and when they jump off the bridge, it goes straight down, but the bungee cord stretches, and the reflexivity inevitably will snap the market the other way. Now, do I think that therefore we're going to be back at 5,800? Probably not. But a market bounce back to 53, 54, 5,500 on the S&P in the weeks or month to come is very much in line with analogs that have happened previously in market declines like this. And so we were targeting the 5,200 to 5,000 area on the downside for this market low. Obviously, this market crash has been so intense this European and Asian session that we blew through that. But we've now met all of our targets on the downside for this move, and it's so oversold that expecting a bounce is likely to happen. And when we get the bounce, let's just assume that there's a chance that this morning's already intraday low could be the low. If we got even a bounce to 5,500, which is right where the fib zone lies, that's a 14% rally, almost 600-700 points off the low. The actual fib zone is like 54.60, so very close to 5,500. So a 10% market bounce off these levels, just reflexively to rally off of this low, is something that can be fully expected here on the short term. You can see the NASDAQ as well finishing a number of these measured moves. This is the so let me just actually look at the the NQ. What I want to highlight here is that when a measured move happens, typically the second wave rarely is shorter than the first off of a market top. But now that we've fully exceeded all these measured targets, again, there might be one more day of selling. Maybe all of these go one more day down, but we're much closer to the end of this. And from an asymmetric perspective, I want everyone to think of it this way. From the market top, right, the S&P dropped 1,300 S&P points. So at this moment, imagine that we have a drop all the way to 4,500 and we go and drop down here. Well, that even if we got down there, that would probably be only a 1 or 2 day visit, which would have the market trading right back up towards 5,000 and 5,100. For this little blip of whatever could happen here in the next day or so, it's just noise in regards to the fact that the vast majority of this wave of selling, and I want to say this wave of selling because the bear market's not over, but this wave of selling is likely done. And that reflexive, like bungee cord snapback is coming. At this moment, it's too late to sell. And the only choice at this moment is to try to benefit from some sort of a snapback rally. Again, you have to be able to stomach, 300-400 S&P points volatility to the downside. Right now, at a 47 VIX, 48 VIX, we're talking about implied daily ranges of 150 points. But right now, we're talking 2-3 sigma moves on an intraday basis, not on a so that I don't know what relevance that is, but the point is that 300 S&P point swings here is par for the course. You just have to psychologically and emotionally anticipate it. And what you also have to recognize, think right now to what your emotional state will be when you see the S&P up 250 points in one day. Will you say, oh shit, I missed the rally? Do I buy now? Because if you know that once the market turns green that you're going to be chasing, you might as well be buying into the weakness rather than being reactive and buying into the rally. At this moment, this opportunity we're buying. Okay, so dollar index, it's stabilized after the one-day drop that happened in there. Currency markets are still kind of not where the big move is actually happening. But what we do want to talk about is the crypto move. Bitcoin did break down. The measured move is all the way down to 70,000. So there is another wave of selling here. Our thesis here all along was that it's a risk asset that's going to correlate with risk equity. And so with everything selling, Bitcoin finally succumbed over the weekend. The other thing I wanted to highlight is that the U.S. dollar against the Chinese renminbi is one to watch, because if this thing in any way breaks out, like you can see, this is a major level around this 735 level, and this is a very managed currency. Let's not call it manipulated. It's a managed currency, and the only reason they would allow the U.S. dollar to weaken in a breakout on the upside, well, anyway, I don't see why they would. It's certainly going to be one interesting thing, because you would imagine that they would be fighting the tariffs by weakening the renminbi, but we haven't seen that yet. So this is, but watch what happens up along the previous highs as we get up there in the next little bit. The just touching on another couple cross currency that I thought was interesting. Obviously, the U.S. dollar against the Canadian dollar has been going through this muddle, but notice how quickly the U.S. dollar recovered against a breakdown move to a lower low against the CAD. This continues to be, I think, my most neutral currency pairing. I think the euro has much more room to strengthen against the U.S. dollar, and I would be far more neutral this. And the other thing I want to highlight is the breakout on the yen. This is most forex traders trade the U.S. dollar yen, but this is obviously the yen chart. This having an upside up to the September highs is also on the table. Moving on, I wanted to touch on gold. Gold and silver correcting, but look, if this correction, this liquidity event, caused a 61.8 retrace to 3,000 to the 50-day moving average, if the market puts in a low today or tomorrow, this is the buy on dip on gold. And this was the type of a retracement we would have expected. Watch to see whether those support lines hold. Silver had a very devastating washout, highly leveraged by speculative traders looking for silver to catch up, created some sort of liquidity margin call event in silver that wiped it out as well. This is a complete buy on dip, recognizing that while there it could be potential economic consequences and slowing economy and tighter global trade and tariffs on different goods, silver and gold are the least impacted out of all of those by tariffs. So the idea that silver was dumping based on tariff news is nonsense. As far as I'm concerned, this washout was a big margin call liquidity event, and therefore makes it a very good buy on dip opportunity looking for a rebound. I wanted to touch also on crude oil. The crude oil measured move is done. I said I was going to buy it down at 62. I am buying right here. This move down here at the $60 level just entered the measured move target on the downside. This is a tactical place to be putting on some crude oil trades for a bounce back to like $65, $66 in the coming week or two. Another thing that I'll highlight is that copper took a massive hit, wiping all the way down to its January low. On an intraday basis, just a complete and total washout. As well, this is the LME, which is the copper futures out in London, even broke temporarily to a lower low. This massive copper crash, while I get it, the economy is going to slow copper demand, but this is repricing too much too quickly, also fading this copper move for a bounce on the upside makes a whole lot of sense. I want to also just highlighting a little bit of a liquidity washing out on uranium, breaking to a lower low. Look, this is not, again, something that I think is going to be drastically impacted. It's much more impacted by broader market liquidity. People are liquidating almost all assets to raise cash, and the selling is getting pretty indiscriminate on the downside. I want to touch on interest rates. First of all, I want to touch on SOFR futures, and where the idea here is that as a recession risk increases, you can see they've finally priced in. This has been a great trade. We've been talking about this for a while, going long the SOFR futures, betting on lower interest rates from the Fed into the end of the year. Notice here that going out to 2026, they've already got interest rates down to 3%. That came pretty quickly. It was a great trade. Congratulations to members that got that move. Similarly, those treasury bonds continue to rise. I was thinking that this would have accelerated a little bit more. It's been a great trade. I still think there's plenty of opportunity in the months to come on continuing to see this rise back to even September levels last year. And finally, global equity. Nikkei now crashed all the way back to its August yen carry trade lows. Vicious decline on the downside, but a very overdone, and very likely to also have a very short-term low soon. And another interesting one was the wipeout that's happening in Europe. Europe has been demonstrating substantial relative strength, but from its peak here just a week or so ago, we saw now an 18% 1,000-point wipeout in just a few weeks. This is indiscriminately going into almost every single market as there's carnage everywhere. China A50 breaking down to a lower low. The India Bombay market finally broke down and succumbed to the selling. Even markets like Mexico had a little pop and drop on the downside. The Canadian market finally broke down and started to sell. So you're literally seeing now this spill into a bigger global equity scare on the downside. Again, short-term low, very likely. We're looking for this market bounce. We covered all of our shorts, and we're adding longs here. Have a good trading day, everyone.